In this video, I cover 6 very specific situations where you should not do a Roth conversion. Coming up next on Holy Schmidt.
Holy Schmidt!
A retiree does everything right. Decades of savings and $500,000 in their IRA. Then they call up their financial planner and they say the magic words, "I want to do a Roth conversion." Several years later, they're down $200,000 or $300,000 because that was the wrong decision. Let me begin by saying this up front. I'm a big fan of Roth conversions when they make sense. But done wrong, they can cost a retiree tens of thousands, maybe even hundreds of thousands of dollars because they shouldn't have done the Roth conversion. There are at least 6 situations where the math behind a Roth conversion turns against you, and you shouldn't have done that conversion. We're going to cover those 6 now. Reason number 1, you don't have cash outside of your IRA. And this is the single biggest reason why a Roth conversion goes wrong, and people end up with less than they think they're going to have. Now here's the math. When you do a Roth conversion, the amount that you convert becomes taxable. So let's say you convert $100,000 and you are in the 24% tax bracket. That means that you owe $24,000 in taxes on that conversion. But how do you pay that tax? Well, if you have tax inside a savings account or a brokerage account, you pay the tax from that account. But a lot of people don't have cash sitting outside of their IRA. So what do you do if you don't have cash outside of your IRA? Well, your only other option is to sell even more inside your IRA, but that takes a big IRA and makes it smaller and sort of defeats the purpose of a Roth conversion. Let me show you exactly what I'm talking about using my friends Callum and Marvin Miller. Callum and Marvin are identical twins. Callum and Marvin are 64 years old. Both have $500,000 sitting in a pre-tax IRA from years of 401k contributions and rollovers. Now here's the only difference between them. Callum has $100,000 sitting in a brokerage account, plenty of cash to pay a conversion tax bill from outside his IRA. Marvin has the same $500,000 IRA, but no taxable savings outside of it. Whatever he owes the IRS for a conversion, he has to pay from inside the IRA. Now let's say that both brothers decide to do the same Roth conversion. Same amount, same tax bracket. We fast forward 20 years to see how both of them have done on a tax-adjusted basis, meaning how they would have done after taxes still owed at the end of the road. Callum, the brother with the outside cash, ends up with hundreds of thousands of dollars more than he would have had if he had done nothing. The conversion worked exactly the way it was supposed to. Marvin, the brother with no outside cash, ends up with hundreds of thousands of dollars less than he would have had if he had done nothing. Same brothers, same tax bracket, same conversion, 2 completely different outcomes. The only difference between the 2 is how the tax bill was paid. So if you take only one thing away from this video, a Roth conversion usually works best when you can pay the taxes from outside of the IRA. And the biggest reason of all is that the dollars that you take out from the IRA to pay the taxes aren't just gone today, they're gone from 20 or 30 years of compounding at a higher rate, more than likely, than the rate you might have in your savings account. And there's a second piece. The whole point of a Roth conversion is to move more of your wealth into the tax-free account. But if you pay the tax bill out of the IRA, you actually moved less. On a $100,000 conversion with a $24,000 tax bill paid from inside, only $76,000 makes it across to the Roth. You shrunk the very bucket you're trying to grow. And that's the math working against you year after year for the rest of your retirement. Point number 2, you're moving. And you're moving to a no-tax state in retirement. Geography changes the conversion math, and a lot of retirees miss this. Right now, 13 states either have no income tax or they don't tax distributions from IRAs and 401ks. Now think about the typical retirement move. New York to Florida is a big one, for example, or Illinois to Texas. Those are 2 pretty typical moves. People move to lower their cost of living and lower their tax burden. But if you do a Roth conversion before you move, you're going to pay state tax on that Roth conversion. California's top rate is over 13%, and New York's top rate is over 10%. And if you live in New York City, the combined state and city tax is over 13%. If you were in a high tax state like these, and you were in the top tax bracket, and you moved to a state like Florida or Texas, you could avoid $13,000 in state taxes on a $100,000 Roth conversion. Now, this isn't a hard no. There might be a good reason to do it anyway. Maybe your marginal tax rate is much lower now than it will be in a year or 2 or 3 whenever you move. And that difference is more than 13%, as an example. But this one in particular is a number you have to run. You can't just guess, because it could get complicated, and if you don't actually do the math, you might be making the wrong decision. Speaking of Roth conversions, a Roth conversion isn't simply a yes or no decision. It's a timing decision. Bolden's Roth Conversion Explorer analyzes your income, taxes, and future RMDs year by year, and then runs multiple scenarios to help you optimize when or if converting actually makes sense. Bolden is one of only 3 affiliates we have on this channel, and it's the personal financial planning software that I personally use. If you'd like to try Bolden free for 2 weeks, you can use our affiliate code. Go to go.bolden.com/Schmidt, and you can try the full featured software free for 2 weeks. After that, it's $12 a month paid annually if you decide to keep it. Reason number 3, you plan on leaving a large portion to charity. Charities are tax exempt, and when a charity receives a distribution from your traditional IRA, they pay 0 taxes on that distribution, which means that if you do a Roth conversion, you're paying taxes on something that the charity would not pay taxes on. In other words, the taxes you paid on the Roth conversion is actual money that the charity could use. And there's a much cleaner way of doing this. It's called a qualified charitable distribution. Here's how a qualified charitable distribution works. Once you turn 70 and a half, you can give directly from your traditional IRA to a qualified charity. The money goes straight from your IRA to the charity. It never shows up on your tax return as income. And there are 3 big advantages to this. 1, you don't pay tax on the distribution. 2, it counts toward your required minimum distribution once those kick in. 3, because it doesn't show up as income, it doesn't push you into a higher tax bracket. It doesn't increase your Medicare premiums, and it doesn't increase your taxable portion of Social Security. So here's the lesson. If a meaningful part of your estate is going to a charity, leave that in your IRA and use a qualified charitable distribution to donate the funds to that charity. Reason number 4, you're already at the top of your tax bracket. Conversions only work if you can fill a lower tax bracket today that won't be available in the future. Otherwise, there's no reason to do a Roth conversion. Pay now at a lower rate, avoid paying later at a higher rate. So what happens if you're already at the top or close to it? Let's say you're at the 35 or even 37% tax bracket. You're paying the absolute maximum cost on the Roth conversion today, only to have that opportunity to pay lower taxes in the future taken away from you. You could have paid lower taxes on the conversion in the future, or maybe if things didn't change, you'd pay the same amount of tax. It's basically a wash, and once you factor in the time value of money, it might actually be a money loser for you. So who does this hit the hardest? Well, there are 3 groups in particular. The first is those in their 60s who are high earners, and they're tempted to do a Roth conversion at the same time. Retirees with large pensions, Social Security, and large future RMDs that all stack up. Their income in retirement might not actually drop. And anyone with significant rental income or business income that they're carrying into retirement. Given that fact pattern, their income might not actually drop either. The next point is that you're within 2 years of an IRMAA cliff. Now this is the one that rarely gets talked about and surprises a lot of people. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's the surcharge Medicare tacks onto your Part B and Part D premiums when your income climbs above certain thresholds. The higher your income, the higher your Medicare premium. And here's the trap. IRMAA uses a 2-year look back. That means that a Roth conversion that you do this year won't show up for 2 years. The IRS reports your income to Social Security. Social Security reports that to the Centers for Medicare and Medicaid Services. And your Part B premium gets a surcharge. And these cliffs aren't gradual. If you cross the threshold by even $1, you could owe thousands of dollars in additional Medicare Part B premiums. If you and your spouse cross that threshold, then you can double that. Here's a concrete example to see just how easy it is to get caught out. Let's say you're planning a $100,000 conversion this year. Without the conversion, your modified adjusted gross income is sitting at $216,000 for a married couple, just under the first IRMAA cliff of $218,000. Add the $100,000 conversion, and your modified adjusted gross income jumps to $316,000. You've now crossed 2 IRMAA cliffs. The surcharge for both you and your spouse in the premium year that the conversion lands on can easily run $5,000 to $6,000 in additional Medicare premiums. So before you convert, project your modified adjusted gross income for that year. You can do that in Bolden, by the way. If your conversion pushes you across an IRMAA threshold by even a few dollars, you owe the entire increase in that tier. Sometimes converting even $5,000 less can save you $4,000 in additional Medicare surcharges. The final point, the market just dropped, and you want to convert while it's down because you pay lower taxes. Now this one sounds smart. The market's down, say 20%, and your friends at the golf club say, listen, if you convert now, you're going to pay 20% less taxes on your conversion. But here's where the logic falls apart. Remember point number one where I said, if you don't pay taxes from outside of your Roth account, you're going to be getting fewer converted dollars because you have to pay taxes on that conversion. Well, here, if you don't have outside dollars to pay your taxes, that conversion becomes a disaster because you're now selling additional shares at a lower price than you would have had you not converted them. The recovery that you were counting on, it still happens, but it happens on a lower number of shares because you had to sell additional shares to cover your taxes. The strategy only works if two things are true at the same time. The first is that you have cash outside of your IRA to pay the taxes, and the second is that you can leave the money inside the Roth so that it can recover. So here's the point that a lot of these videos miss. A Roth conversion is a tool. It's not a destination. Sometimes it is a wonderful tool. Sometimes it's not an appropriate tool depending on what's happening in your life. The people who lose money on Roth conversions aren't necessarily the people that do the Roth conversions or the ones that avoid the Roth conversions. They're the ones that do the Roth conversions without checking the math. It's important to check the math. If you like this video, check out that video. It's one of my most popular with over 380,000 views. Most retirees don't know that this Roth conversion window closes in 2028. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.